on to something for just one more day before selling it can sometimes be incredibly beneficial. That's why it's important to understand what short-term and long-term holdings are and the tax implications for each. So there are two important things to know. First is that the gains on the sale of assets, and whether that's stock or crypto or a house, really any asset that you purchase for less than you sold it for, those gains are not all taxed at the same rate. And if the asset that you sold was held for more than 1 year, you do not pay ordinary income tax rates on that gain. Ordinary income tax rates are the kind that increase as your income increases. If you hold the asset for 1 year or more, you'll pay either 0%, 15%, or 20% on the gain that you incurred, as opposed to the 12 to 37% ordinary income tax rates. So the key when holding real estate, crypto, stocks, really anything like that, is to hold on to it for at least a year and a day. That way you'll guarantee that you pay the lower tax rate on that income, that gain, that you earn. The AGI limits for long-term capital gains rates are actually pretty high. So if you have a lot of income derived from long-term capital gains, but not much income from other sources, you might actually pay 0% tax on most of that capital gain income. Now remember, be smart. Don't just hold on to the asset just to get over the 1 year mark. If you're unsure that the asset will be worth as much in 6 months or whatever the timeline is to get you to that mark, just sell it. Pay the higher ordinary income tax rate, but at least you have your gain. But to pay the very best tax rate, hold on for at least a day and a year and you won't pay more than 20% long-term capital gains rate on that gain.